Hello there, MSL here, and welcome to this video on the summary of IAS 40 investment property. This standard applies to the accounting for property that includes either land or buildings that is held to earn rentals or for capital appreciation or for both. This standard has been through a lot of changes right from 1984 all the way through to December 2003 when the current form of IAS 40 that we have was issued. So as a standard, IAS 40 investment property was reissued in December 2003 and it was to apply to annual periods beginning on or after 1st January 2005. So how does IAS 40 define an investment property? The standard is clear. An investment property is any land or building or a part of a building or both that is held by the owner or the lessee under a finance lease to earn rentals or for capital appreciation or for both rentals and capital appreciation purposes. Some examples of investment property as provided for under IAS 40 include any land that is held for long-term capital appreciation, any land that is held for a currently undetermined future use, any building that is leased out under an operating lease, any vacant building held to be leased out under an operating lease, and any property that is being constructed or developed for future use as an investment property. Now that we know what is within the scope of IAS 40, what are the items that are outside the scope of IAS 40 investment property? The first is any property that is held for use in the production or supply of goods or services or for administrative purposes. And these will typically be accounted for under IAS 16 on property, plant, and equipment. The next out of scope item will be any property that is held for sale in the ordinary course of business or in the process of construction or development for such sale. These will typically be accounted for under IAS 2 inventory. The next item will be property being constructed or developed on behalf of third parties. These were previously accounted for under IAS 11 construction contracts, but with the introduction of IFRS 15, these will be accounted for under IFRS 15 revenue from contracts with customers. The next out of scope item will be any owner occupied property. This will clearly be accounted for under IAS 16 property, plant, and equipment. Also, any property that is leased to another entity under a finance lease will be outside the scope of IAS 40 but will fall under IFRS 16 on leases. Then take note that in May 2008, as part of the IASB's annual improvements project, the IASB expanded the scope of IAS 40 to now include property under construction or development for future use as an investment property. Such property were previously under the scope of IAS 16 property, plant, and equipment. Now that we know what is outside the scope, how does the standard deal with recognition, or what are the rules for recognition of investment property under IAS 40? So IAS 40 says that for investment property to be recognized as an asset, then it should be probable that the future economic benefits that are associated with the property will flow to the entity, and the cost of the property can be reliably measured. You will note that this is very similar to the recognition principles under IAS 16 property, plant, and equipment. So after recognition has been met, at what value will the investment property be initially recognized in the statement of financial position? IAS 40 provides that investment property should initially be measured at cost, and this should include transaction cost. However, such cost included in IAS 40 investment property should not include any startup cost, should not include any abnormal waste, and should not include any initial operating losses incurred before the investment property achieves the planned level of occupancy. Now that we know the rules around what goes into initial recognition or initial measurement, what are the rules for subsequent measurement after initial recognition has been satisfied? IAS 40 provides under subsequent measurement for two possible approaches. The first is the cost model, and then we have something called the fair value model. It is important to mention that under both, the thing is to remember that one method must be adopted for all investment property. So if you choose cost model, you must apply consistently to all investment property. If you choose fair value model, you must apply that measurement method to all your investment property. Then it's also important to remember that a change in method or model is permitted only when it results in a more appropriate presentation. Take note, however, that IAS 40 has said that this is highly unlikely for a change from a fair value model to a cost model. Then remember that a fair value model under IAS 40 investment property is not the same as the revaluation model provided for under IAS 16 property, plant, and equipment. So now that we know the subsequent measurement options that are available, let's look into detail at the fair value model provided for by IAS 40. Under the fair value model, investment property is remeasured at fair value, and this fair value is the same fair value provided for under IFRS 13 fair value measurement, which is defined as the price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. When you develop or you decide on what the fair value is, then any gains or losses arising from changes in the fair value of investment property must then be included in profit or loss for the period in which it arises. It's key to remember that there's a rebuttable presumption that the entity will be able to determine the fair value of an investment property reliably on a continuing basis as provided for under IFRS 13. However, there are some special use cases. Before we get to those ones, remember that under IFRS, you are not required to depreciate any investment property that is held under the fair value model. Then, what are these special use cases I mentioned? So, these special cases under the fair value model will cover things such as investment property that is currently under construction. So, for these ones, if an entity determines that the fair value of an investment property under construction is not reliably determinable, but they expect the fair value of the properties to be reliably determinable when construction is complete, then the entity is required to measure the investment property under construction at cost until either the fair value becomes reliably determinable or construction is completed. This is for investment property under construction. How about investment property that is not under construction? So investment property other than those under construction, the rules are simple. They are saying that where the fair value of an investment property is not reliably determinable on a continuing basis, then the entity is required to measure that investment property using the cost model under IAS 16 property, plant, and equipment. Where this approach is adopted, the residual value of the investment property will be assumed to be zero, and the entity is required to apply IAS 16 until disposal of the investment property. Now that we've looked at the fair value model, what are the rules under the cost model? Under the cost model, IAS 40 provides that after initial recognition, investment properties are accounted for in accordance with the cost model as provided for under IAS 16 property, plant, and equipment. That is, it should be at the cost less any accumulated depreciation and less any accumulated impairment losses as provided for under IAS 36 impairment of assets. We've seen the cost model, we've seen the fair value model. What are the rules when it comes to transfers to and from investment property? The standard is clear that you can only make transfers to or from investment property when there is a change in use, which is evidenced by a number of different indicative factors. The list is not exhaustive, but some of these include: the first is when there is commencement of owner occupation. Under this scenario, this will be treated as a transfer from investment property under IAS 40 to owner-occupied property under IAS 16 property, plant and equipment. The next is commencement of development with a view to sale. This will be treated as a transfer from investment property IAS 40 to inventories under IAS 2. The next is the end of owner occupation. This will be treated as a transfer from owner-occupied property under IAS 16 to investment property under IAS 40. The next is the commencement of an operating lease to another party. This will be accounted for under IFRS 16 on leases. Then the final one is the end of construction or development. And this will be treated as a transfer from property in the course of construction or development, that is assets under construction, to investment property under IAS 40. So what are some other classification issues that are presented with this standard? I'll give you three. There are quite a number, but these are the three key ones you need to know. The first is partial own use. So here, if the owner of an investment property uses part of the property for their own use and part to earn rentals or for capital appreciation, and the portions can be sold or leased out separately, then they are required to be accounted for separately. So the part that is rented out is investment property, but take note, if the portions cannot be sold or leased out separately, then the property is investment property only if the owner-occupied portion is insignificant. The next classification issue will arise in cases of ancillary services. So here, if the entity provides ancillary services to the occupant of a property, then the appropriateness of the classification as investment property is determined by the significance of the services provided. What do I mean? If those services are a relatively insignificant component of the arrangement as a whole, then in this case, the entity may treat the property as investment property. What do I mean by insignificant? For example, if the building owner supplies security and maintenance services to the lessees of the property, this would be a typical example. So in this case, where the services provided are more significant, such as where the case is in an issue of an owner-managed hotel, then the property will be deemed to be owner-occupied. The final classification issue will arise under intra-company rentals. So in this case, where there's property that is rented to a parent or a subsidiary or a fellow subsidiary, then we'll say this will not be investment property in the consolidated financial statements that include both the lessor and the lessee. And it's only because the property is deemed to be what owner occupied from the perspective of the group. This would be in line with principles of IFRS 3 business combinations and IFRS 10 consolidated financial statements. However, such property could qualify as investment property in the separate financial statements of the lessor if the definition of investment property is met. So these will fall under the rules of IAS 27, separate financial statements. Let's talk about the rules when it comes to derecognition of investment property. IAS 40 provides that investment property should be derecognized, number one, on disposal, number two, or when the investment property is permanently withdrawn from use and no future economic benefits are expected from the disposal. In such a case, upon disposal, the gain or loss on disposal should be calculated as a difference between the net disposal proceeds and the carrying amount of the asset, and this should be recognized as an income or expense in profit or loss. Take note, however, that any compensation from third parties is recognized when it becomes receivable. Under this standard, there are a number of disclosure requirements for both the fair value model and the cost model. Then the fair value model has its own special disclosure requirements, same as the cost model. So this has been a summary of IAS 40 investment property. If you love this summary, don't forget to smash that like button and don't forget to share this video within your entire network. I'll catch you in our next IFRS summary video.